In this chapter, in section 1, we purchased plant assets. They depreciated in value. And this final section, we're finally done with section 1 after today. What happens when you get rid of them? Okay, that's what disposal means. And companies will dispose of their plant assets one of 3 ways. They'll either retire them, sell them, or exchange them. We are not going to cover the exchange part in the chapter. It is in the appendix piece, but you will not be presented a problem on exchanging. You will not be tested on an exchange. So let's just think about what this means. If you retire an asset, you're junking it. You're getting rid of it. You're throwing it away. You're putting it on the curb. You're demoing it. You're just getting rid of it. You're disposing of it, retiring it. Okay, here you'll notice the tow truck off with the asset. A sale means you're selling it to someone, either a business or another party. And then exchanging it means you'd be getting a new one, which we won't be covering. What happens from an accounting perspective when we either, we know there's 3 ways, but we're only going to cover 2. When we either retire it or sell it, you basically have to get the depreciation up to date. Before you can send it down the road or put it in the garbage, you have to get your depreciation up to date. Up to date for the year or up to date if you sell it mid-year. So before it can happen, you have to say, all right, am I up to date on depreciation? Because that is a cost of doing business. And to eliminate the asset, you actually zero out some stuff. In the first example that we do, I'm going to actually write 2 little T accounts so you can see some numbers in front of you. When we retire or dispose of a plant asset, we are not getting money for it. In fact, we might even have to pay to get rid of it. What's going to happen is we're going to debit accumulated depreciation and credit the asset account. I think this is where I should write it, make the T's. Okay, so let's say we've got equipment. Then I just don't have to do this later. Equipment is an asset that has a normal debit balance, and a credit would be a reduction. Okay, I'd write these, I'd draw these. What's the contra asset to equipment? We have accumulated depreciation on the equipment. Okay, it's a contra asset. So that means everything's opposite. Okay, so if I'm sitting here with a $1,000 piece of equipment and it has an estimated 0 salvage value, like I'm not going to get any money out of it. Maybe every month, you know, here's maybe 1 month we have a $250 accumulated depreciation, which means I take that depreciation expense bucket and start throwing it over in my other pile that's piling up. And then the next month I have another one. And the next month, or let's just say year. Okay, so it's sitting here at a $1,000. You see now my equipment minus its contra asset is 0. Okay, well when I zero all of them out, notice what this is saying. When I am going to throw it away or it's not worth anything anymore, I would have I'll start up here, a debit to the accumulated depreciation expense for its amount, which would make this 0, and a credit to the assets, which makes that 0. So when we're getting rid of it, we first have to do this. Does that visually make sense? Hopefully. How does this look in accounting? Hobart Enterprises retires the computer printers, which, you know, printers, electronics oftentimes have a zero. They depreciate down to nothing. You literally have to usually pay to get rid of them, to throw them away. Okay. They cost $32,000. The accumulated depreciation on these is $32,000. So this tells me that there is no salvage value because the cost of them was 32 and the accumulated depreciation was 32. Just like that $1,000 example that I just showed you. So to get depreciation up to date and to get rid of them, we debit and credit $32,000. Just how I just played those two things out, because here's my equipment. So if I did my example from the previous slide, it would be a $32,000 instead of $1,000. We had these $32,000 worth of printers around, but the accumulated depreciation pile was growing to that zero salvage value. And here's what it looks like. We're getting rid of the asset, but we're also wiping out the accumulated depreciation pile that goes with it. What happens if a fully depreciated plant asset is still useful to the company? Like, what if they don't need to throw it away? Let me read to you what the chapter says about that. In no situation can the accumulated depreciation on a plant asset exceed its original cost. So I bought this $32,000 worth of printers, and every year I was dumping a little bit over in my accumulated depreciation pile. That depreciation pile cannot get larger than $32,000. Because according to what the book says on page 484, I'll read it again. In no situation can the accumulated depreciation on the plant asset exceed its cost. And you know, people do that. You don't go get rid of your car that might have a few bumps and bruises and scrapes in it just because it's hit its useful life. Not one bit. You still drive it. It just can't depreciate more than what you originally paid for it. Okay. Here's the game changer. Here's the most challenging part of this chapter, really, I think. Sunset Company discards delivery equipment that cost 18. Is the depreciation pile 18 yet? The depreciation's only 14. Did we have a gain or did we have a loss on the sale? Let's see how it shakes out. The accumulated depreciation pile is 14,000. We lost 4,000 because we originally paid 18, excuse me. We originally had a purchase of $18,000. I know that it's easy to see the math. That was the original purchase. Minus what it is accumulated so far. We actually take a $4,000 loss on that. Ideally. It is. Because it's like we should have squeezed $4,000 more of life out of that thing. But it broke, died, isn't usable anymore. So since we didn't get it to its full depreciation or its full purchase price, that's seen as a loss. Are you two betting again back there? Ah, good question. You need to look at a gain or a loss as revenue. So a gain on a disposal is like revenue. So yes. Let's get into the more challenging one. What about when we sell? This is not throwing away, this is selling. If we sell something, we will have a cash debit. But if you sell an asset, what do you know is going to be the credit? The asset's going to go down because it's gone. We're selling it. So you're going to have two assets. One's debited and one's credited. When you sell something and get money, cash is your debit. When you sell something, another asset, and it's gone, that asset's the credit. Now there's other players here. You basically take a look at the book value of the asset with the proceeds, with the money coming in from the sale to try to figure out, did you make money or lose money? And you might say, whoa, hold the show. No, don't think of it that way. Because I did. If I sold something, I got cash. But an asset's also gone. And then is that seen as revenue in or a hit against the revenue? If we have a gain, that is a credit. If we have a loss, that is a debit, because I need you to think of gain and loss similar to sales revenue. You know, like when I'm selling stuff, I think of it like a cousin, okay? It's not the livelihood, because remember, Willie's doesn't sell grocery carts. Willie sells food. Their inventory, their livelihood is groceries. But they also buy things like cash registers and grocery carts. And so if they go to sell their old grocery carts to go get new ones, which happens, that's not considered revenue in. It's either a gain or a loss on a plant asset. Because remember, plant assets we need around to do business. So do you see how it's like a cousin to sales? Here we go. On July 1st, when did this happen? Not on January 1st, not on December 31st, mid-year. Right company sells. I see the word sell, so I know I'm getting cash here. They sold office equipment for $16,000 cash. And this happened July 1st. I'm circling things that are important. The office furniture originally cost $60,000. As of January 1st, it had accumulated 41 plus what? So I bought this $60,000. I bought this $60,000 worth of equipment. Every year I was taking my depreciation expense pile and dumping it over into that other pile. That pile had grown to $41,000 plus what? January, February, March, April, May, all of June, plus 6/12 of 2014. Depreciation for the first 6 months, they told us, you're lucky. You didn't have to do any math. So the accumulated depreciation pile was $41,000 plus the $8,000, which was 6/12 of 2014. $49,000 depreciated. Okay, we've got some players here. I don't have a lot of space. Do you have this thing in your notes? Perfect, okay? Before we can talk money, keepers, I get this excited about accumulated depreciation. Before we can even talk about the sale, we have to get our depreciation up to date. So that's where you say depreciation expense of $8,000, and our accumulated depreciation pile also grew by $8,000 because this was January through June. So all of January, all of February, all the way through June is 6 of 12 months. then we can talk money in our pocket. And here are the players. The players are this. Original cost of furniture, 60 grand. Minus 49,000. Because the 8,000 was 6 of 12 of 2014. So its book value when we sold it was 60,000 minus that $49,000 pile sitting over there. Whew. So it was actually valued at 11. We sold it for 16,000. 11,000 minus 16,000 is a surplus of 5 grand. And I know that seems weird to say 11,000 minus 16, but it visually makes sense a little bit better. That I've got 11,000 minus 16,000. Holy cow! I've got a pile of $5,000 sitting there. That's like a surplus. What does this look like then? You take these players and journalize them. What did we get? What did we get out of this deal? And I'm not talking the gain right now. What did we get? We got $16,000 cash. What did we lose out of this deal? Another asset, right? A $60,000 asset went goodbye. What's debited though to offset that big difference? We kicked that accumulated depreciation pile out the door too. So accumulated depreciation, whoa, wait a minute, I thought it was 41,000 according to the book. Had we sold it on December 31st? Yeah, but we had $8,000 more that happened in 2014. Now, is accumulated depreciation like an asset coming in? No, it's a contra asset going out. Speaking of going out, that $60,000 piece of equipment is gone. Do our debits equal our credits right now? No, because we also got a gain. Remember, this is revenue's cousin. Is it good when we have a revenue credit? Yeah, that means money coming in. Remember, by selling this office furniture is not our livelihood. We need the office furniture to have our livelihood happen. So it's kind of like a good thing, kind of like revenue, but we're not going to call it revenue. We're going to call it a gain on the disposal. Let's say, assume, we're still talking that same $60,000 office equipment. Assume we were selling it for $9,000 instead of $16,000. Did I put this in your notes? So we still had this office equipment less, and I want you to put this in, 41,000 plus 8. Because remember that was the 6/12 of 2014. Okay. It's still valued at 11 grand minus 9,000. We only got 9,000 instead of 16. So 11 minus 2, I'm sorry, 11 minus 9 is 2, and that's bad. Because it's worth 11. We only got 9 for it. That's a loss. Is a loss debited or credited? Debited, because it's not money in our pocket like revenue is. So we still got our cash, only this time it was only 9,000. Accumulated depreciation was still that 49. What left our building though? And it's going to give us the next loss. I'm sorry, I wish it would go right to equipment. That's gone, that's out the door, but this is money in the door. But this is a contra to this. You can see it shake out a little bit better here, and a loss is a bad thing because it's not money out, it's just not money in like a revenue. So don't think of it as money out, like money out of our pocket, it's just a hit. It's certainly not money in. It's time to do some exercises. Just remember, when we're selling something, we got to first put up a big stop sign and say, oh, hold the show. We got to get our depreciation up to date before we can even take money in. Not sure if this has room in your workbook. You can just write it on the back of your new, whatever they're called, packets. But please find exercise 10.9 in your book. Before we even get started with this, I want to just talk about the 3 ways to dispose, or excuse me, the 3 ways to get rid of a plant asset. Remember, we got to buy it, it's going to depreciate or lose its value, and then we're going to dispose of it somehow, okay? What are the 3 ways to get rid of? Dispose or retire. Those 2 kind of go hand in hand. What's another one? I heard McKenna say it. We can have a sale, or we can exchange. I want you to recognize that that's an option, but like I said, the chapter is not even talking about it. So that's why I put it kind of at the bottom of the list. When we sell something, we first need to update depreciation, and then we can accept the money. If we're going to retire something, if it hasn't gotten to its original cost and we sell it sooner, we're going to see a loss there. Okay. As I do this with you, we're gonna do that little quick math equation of all the players, because then it's just a lot easier to journalize them. So here we go. I'm on page 505. Presented below are selected transactions at Ridge Company. Please be attentive of the date for 2014. January 1st, we retired a piece of machinery. So are we getting money on this one? Nope, it's going to go sit in the graveyard. Or we're going to throw it away, whatever. The machine cost $62,000 on that date. It had a useful life of 10 years with no salvage value. So it was 10 years old. It had depleted down to nothing. It's a simple accumulated depreciation on that equipment is $62,000 because it had no salvage value. Its useful life was done, and then that equipment left us. So that is the exact, and I don't have a lot of space here, but if I made this little equipment thing, and it's contra account accumulated depreciation on the equipment, what they're saying is we had this $62,000 piece of equipment. Its accumulated depreciation pile had grown to that same amount over its useful life. And to get these to be 0, I simply need to do its opposite. So I would debit $62,000 and credit $62,000 to force them to be 0. When we retire something, it's pretty easy that way. Now, before I do this next one with you, we have to take a look at what's happening. Sold. Before I can get money, what do I have to do? I have to update what? How much it's depreciated. Okay, so keep in mind, we're looking at depreciation for 2014. We sold a computer. It had original cost, 5 years of useful life at no salvage value. The computer was sold for $14,000. I'm not worried about money in yet. I'm worried about getting my depreciation up to date because when did I sell the thing? June 30th. How many months am I needing to update? January, February, March, April, May, all the way through June. So 6 of 12 months I need to get updated. If you take a look, it should have said that we're using straight line depreciation on everything. Does that say that anywhere? Yes, the company uses straight line depreciation. It's down below in the instructions. So what did this thing cost? Who cares? Why don't I care? Oh, I do. It's $45,000. I thought we'd need to know the depreciable value, but they're not giving that to us. Game changer. I don't have a lot of writing space to do my extra math, so I'm going to do that up here. Our $45,000 piece of equipment. We're taking a look at our straight line, so 1/5 of our useful life times 6/12 of its current year. Because remember, straight line depreciation depreciates the same amount. So in 1 year's time, it would be 1/5, okay, times the 6/12 that we used it for. This is a two-part transactions because we need to get depreciation up to date. And the type of depreciation according to the book directions was straight line. It would be way different if it was units of activity or double declining. Are we ready to sell the thing? Yes. I want to list our players. I think I can do this. Yes, perfect. We've got a couple things going on here. Our players include cost. I want you to write these somewhere. What did this thing originally cost us? What asset is going to be leaving us? Thank you. Can I just put 45K since I don't have a lot of room? Mitchell? Yep, and it's straight line, so it's depreciating the same every year, so 1/5. Yep. Yes. Yep. Yep. Good. Okay. What amount has it accumulated so far? So accumulate, I'm just going to put AD. So minus AD. How much has it accumulated so far? Any idea? I have to look and see where this came from. You ready for this? 31,500. Let's stop and see why. We bought a $45,000 piece of equipment. How many of the 5 years have we had it? How many of the 5 years have we had it? So we've had it for 3 years. Now remember, the question Mitchell just asked, that was the depreciation expense for that year. But remember, I'm dumping that pail over here, and we've had it for how many years? 3. Do you see how to get that? When did we buy it? We bought it on January 1 of 2011. So we have it all of 2011, all of 2012, all of 2013 because we're in year 2014 right now. So we've had it 3 years. And that amount equals, and I'm just looking right here, 27,000 plus what? The 6/12 of this year. So back down to here. Our player. What's its book value right now? Book value right now is 13.5. Minus, what did we sell it for? What was the sale? 14,000. So if I had something worth 13.5, but I got 14 for it, we gained $500 on this thing. So now we take all of these little players. The book doesn't ask us to do this. I like to do this because I like to know where these numbers are coming from. We need to journalize this. What was the asset that came in? What did we gain here? How much cash? Look at the player. 14,000. What accumulated depreciation pile was wiped out? Because when we sell an asset, the accumulated depreciation pile gets wiped out as well. 31,500. This shows that equation as well, where I got that dollar amount. We bought a $45,000 piece of equipment. We used it 3 of 5 years, but then plus what we used to get it up to date. The gain of $500 is shown as revenue's cousin. Don't think of it as money in. Think of it as, hey, we earned a little bit of extra bonus money here. And then, of course, the $45,000 asset, or the equipment in this case, is gone. Do you see why I didn't want to hurry this last Thursday? It looks like we had another sale, I think, on December 31st. Oh, no, we discarded a delivery truck. But remember, we need to get our depreciation updated before we can get rid of something. If we discarded this on January 1st, then no, the depreciation would have been updated, but we discarded it on December 31st, so we used it a whole year. If we would have just waited to throw the thing away till January 1st, we wouldn't have to update that depreciation. All right, so what's going on? We discarded a delivery truck that was purchased on January 1st, 2010. That matters. The truck cost $33,000. Had a 6-year useful life, and we hope to get $3 grand out of it. So this is the depreciable value. Why did this not have a depreciable value? If you go back up and look, it wasn't going to be worth anything at the end of its useful life. So it's like 45 minus 0 is 45. In this case, we hope to get 3,000 out of this thing. So this was its depreciable cost. So 33 minus 3, so it's depreciable cost of 30 times the 1 out of 6 years that we used it. Because remember, yeah, we bought it way back in 2010, but this is only getting up to date for this year. This is the pail, not the pile. This is the pail. I'll say it one more time, not the pile. Why don't I have to take it times a fraction of 12? Because when did I sell this thing? At the end of a full year. If I would have sold it in November, then I would have had to take times 11 of 12. But I didn't. Now we can go around, turn around and sell it. How much? Well, let's do our little player over here instead. our asset of $33,000 minus its pile of AD, $25,000 that is grown to, we've taken a loss because we got rid of it too early. 33 minus 3, remember that's the depreciable cost. Now why am I seeing times 5 of 6? That's the pile, not the pail. If I bought something in 2010, I used it 2010, 2011, 2013, 2014. I would have thought that would have been a 4 out of 6. Did I say something wrong? I skipped a year? Okay. So we've used it 5 years. 2010, 11, 12, 13, 14. Thank you. I did skip a year. You're right. So this was the little pail for the year that we were dumping to this large pile. Why do we not see cash involved here? We didn't sell it. We retired it. We disposed it. It's gone. And why is it a loss? Got rid of it before its useful life was over. If we would have waited a year and used it a year, it wouldn't have been a loss. Let's do another problem. I can't stress enough, this is why I didn't want to rush this last week. It's complicated, especially when we're buying and selling things mid-year. I'd go to a new page. Okay, I like this problem because we're dealing with one asset. Let's take a look at exercise 1010 on page 505. Price Company owns equipment that costs $65,000 when purchased on January 1st, 2011. Yay, thanks for buying it at the beginning of the year. It has depreciated using the straight line method with an estimated salvage value of $5,000 over 5 years. Okay, so pretty easy players. Okay. It says Price Company prepares journal entries to record the sale of equipment. And these are 4 independent situations. Like, what if we would do it this? What if we would do it here? What if we do it there? So A, B, C, D, what you see here is selling the same piece of equipment at different times of year for different amounts. So these are all independent. They don't like work together with each other. And you know, the analytical people would maybe do this. They'd maybe run their numbers. If we hold on to this asset for another 6 months, maybe we could get more money out of it, or it's going to depreciate more or less. And so they'll take a look at stuff like this. Like, we've got to use this. Our school does it all the time with buses. We have to use this bus one more year to get our best money out of the deal. Does that make sense? Why you'd like look at this 4 different ways? We're not selling this asset 4 different times. We're just looking at it 4 different ways. Okay. Here we go. If we're selling it on January 1st, do we have to update any depreciation? Nope, we don't have to get it updated. It already is updated. So, see, I don't have a lot of space, so I guess I do over here. I'm not going to continually do this player thing. Well, maybe I should. I did it when I'm going to quit talking and just do this. All right, what was our asset valued at? What did we buy the asset for? $65,000 minus its accumulated depreciation. I'm going to tell you right now, it's 36. How did I get that? Straight line. It does have a salvage value. Okay, so I'm going to take 65 minus 5. Its depreciable value is $60,000 times, it's got 5 years of useful life, and how many of it have depreciated? Okay, where did we get that 3? We bought it on January 1st, 2011. We sold it in 2014, so we used up all of 2011, 12, and 13. Okay, so it depreciated then the $36,000. Okay, what is our book value then? If we bought the $65,000 thing and it's depreciated 36, has it depreciated down to 29,000? Minus, what did we sell it for? So if a $29,000 thing we sold for 31, did we have a gain or loss? We had a $2,000 gain. So then we use those players in this equation. $31,000 cash in our pocket. However, a $65,000 asset has gone, but we've also kicked away that pile of $36,000 that's lost in value. So these two go together. And then our gain, which is revenue's cousin of $2,000 by disposing that asset, also happens. You can decide if you're going to put the dollar amounts or the math in as they do it. I am showing it to you other ways as well. And whatever way makes the most sense for you, great. And just remember, this is revenue's cousin. We need this equipment to do business, to make money. Is this considered revenue on this gain? No, we just are selling something that we needed to make money, and we happen to be making a little bonus money off of it. Let me ask one more time, why did we not need to update depreciation? This is the start of the year. Is that the case in this next transaction? No, it's not. In the next transaction, it's still the $65,000 piece of equipment, because remember, they're just analyzing it 4 different ways. They're not selling the piece of equipment 4 different times. Okay? We sold it for $31,000, same dollar amount, but we waited until May 1st. So number 1, we have to do what? If we used it January, February, March, and April, we have to update the depreciation first. Okay, so we take its depreciable value, that's this. That's a depreciable value. You could have, if it didn't have a salvage value, you still could say 65,000 minus 0. Times the 1/5 of this pail this year. Who cares that we're going to dump that pail over to depreciation pile eventually? It's what it's depreciating this year. So the 1/5 that's being used times only 4/12. January, February, March, April. I thought we sold it on May 1st. Yeah, you didn't use it in May. So our depreciation pile filled up to $4,000, and then I went and dumped it over here as that grew. How much money? We still earned $31,000. Again, we're not selling it twice. We just started looking at it if we keep it around for 4 months more. Accumulated depreciation was 2011, 12, 13. Do you want to know how I got that number? Maybe? Well, how do we know that it's going, how do we know that it got to 36? Because it's 60,000 times 1/5. So 12,000 a year times 2011, 12, 13. Not showing you that math, that makes me a little nervous. But it's going to depreciate $12,000 straight line every year, plus the 4 here. Don't forget that you had it around January, February, March, and April. So stay here for just a minute, okay? You've got 40,000, oh wait, no, 40,000 here instead. So 25 minus 31, we had a gain. Giving you homework. You got to do the rest of exercise 1010 by yourself. Do the rest of exercise 1010 by yourself. I'll send you a remind. You have C and you have D. You did it already? Good. If you want to stop in and have me help you with it, you're welcome to. I'm only here till 3:30 today though, but I could help during lunch.